Steve Sosnick here with today's Interactive Brokers Midday Market Update for Tuesday, July 7th, 2020. For those of you who haven't seen me in a while, I actually was able to get a haircut. So I look a bit different, which is a good thing, I guess. But it was nice to have someone actually come by the house and do it on the deck. But anyway, personal stuff aside, we were setting up for a risk-off morning this morning after a sharp rally yesterday, after rallies the last few days, after NASDAQ had been up 15 of 17 days. As of now, I would have said it was a little bit of a risk-off, but at this point, NASDAQ is higher and S&P is about to go unchanged. So that doesn't last very long in this kind of market. The psychology is still that every dip is to be bought, and until or unless investors get penalized for that or traders get penalized for that, you're going to see the behavior. Why change your behavior if it continues to be self-reinforcing? And I think that's what we're seeing today. Yesterday, I put out a piece which I would like you to read. It works much better in writing, but I'll refer to it today because I know some of you prefer video learning. And that was, yet again, the Fed reduced the size of its balance sheet last week, third week in a row, and it's clear that they seem to be not necessarily putting the brakes on, but they've certainly taken their foot off the accelerator. Markets usually respond to that and respond to changes in monetary policy in about a 2 to 3 week period. Now, of course, the up moves tend to be much sharper than the down moves. But what we saw last year when the Fed was gently reducing the size of its balance sheet, the markets meandered sideways at best and had somewhat of a lower tone, ran into trouble into August and September, which is part seasonal, part because there was the repo crisis. And then the Fed expanded its balance sheet by about 10%, which seemed big at the time, but seems quaint in comparison. And the markets took off and really went up unabated until COVID hit. Actually beyond when COVID hit, but again, markets tend to have self-reinforcing behavior. So, the dip buyers continued to be rewarded until the day they got clobbered. But this is going to set up to be a very interesting month, and seems to be without added impetus from the Fed. They're not openly hostile to markets, but without real without really them helping the market. They're not hurting, but they're not helping to the degree that everybody thinks. Ask almost anybody, what's the Fed doing? Well, the Fed's super accommodative. The Fed has super accommodative rhetoric. The Fed balance sheet is telling you that they are vigilant at best, watching and waiting, maybe trying to take some of the liquidity away, probably maybe hoping to save some if they need it again. But don't count on the idea that a Fed is going to be wind at your back the entire time. As of now, they're not hindering, but they're not helping as much as you'd think. But there's a lot to think about as we go forward. July, there's a lot to talk about. First of all, taxes are due this month. That's not usual in the U.S. Usually taxes are due April 15th, death and taxes, right? But this year, taxes are due as a result of COVID on July 15th. There was some hope that they might extend that, but the Treasury said no. And what that means is basically taxpayers who expect a refund typically do their taxes early. Taxpayers who need to pay taxes typically wait till the last minute because that's normal. You don't want to part with your money any sooner than you have to. And 2019 was a year where there were a lot of trading and capital gains. So I would expect that a lot of investors will have to add some liquidity so that they can pay their taxes. And it's not clear how that will affect things. Normally April 15th, there is a bit of a sort of a seasonal high around then. It's just before first quarter, end of the year earnings, of the first earnings release of the year season. Also, you have money coming into the market in April because of IRA investments. And you're not going to have that impetus of money coming in, but you do have an impetus of money coming out. It's not clear to me what that will be, but it's not a positive. And then basically right on the heels of that begins earnings season, actually slightly before. Pepsi's, I think, on July 13th, JP Morgan July 14th. So we're going to start to see money coming out just as a very critical earnings season comes in. There's very little guidance. Most companies have withdrawn it, and in many cases, the analysts are not getting the type of guidance they're used to. So you're seeing much more dispersion in terms of analyst estimates, and that in itself could create some volatility. And basically, all the big cap names, the entire FANG, the bulk of the NDX and SPX, all reports before the end of July. So there's a lot to unpack in terms of fundamental data. Some of the value, I don't have to tell you that some of the valuations are truly stretched, and that's definitely something that works against stocks in earnings season. But we'll see where that goes. That's just one other hurdle for the markets to deal with. Another one is the fiscal cliff at the end of the month. The $600 a week supplemental payments expire in July. As of now, there is talk of some fiscal stimulus to replace it. It's not clear what form that's going to take or how big it is. I've heard educated numbers in the 1 trillion to 1.5 trillion range. It's not clear how much of it will reach individuals versus small businesses versus large businesses. And a lot will depend on the timing and composition of that fiscal stimulus. Basically, the markets are reliant upon monetary and fiscal stimulus to continue their advance. As of now, we've shown you that the monetary stimulus is on hold and the fiscal stimulus remains to be seen. That is definitely a factor for the markets to reckon with. And of course, there's COVID. It is not getting better as of now. It remains to be seen how much worse it gets in the U.S. It's a human tragedy. But from an economic point of view, remember that the employment numbers that came out last week, they only went through June 12th. COVID really started to get bad, and the rollback started to reoccur in the U.S. Later in the month. So that's really technically next month, first week of August. But you have COVID-related headlines that at least of now are not market friendly. So can the market overcome all this? Yeah, it has, and it has, and it very well could. And right now, the path of least resistance remains to the upside. But I'm urging you to consider all the factors that are out there, consider the remarkable performance that we've had, and decide whether your risks, the risks that you're taking in your portfolio, are appropriate for the type of hurdles that the market has to overcome. If you think they're just going to be minor little bumps in the road and the market's just going to pop over them, well, position yourself accordingly. If you feel that these are real risk factors that could upset a market that is extraordinarily highly valued and extraordinarily momentum driven and has gone parabolic in certain instances, then position yourself accordingly there or hedge accordingly there. Anyway, have a good one, and please read the piece. We'll link to it on the landing page. Take care. Bye-bye.